To understand the financial machinery of modern manufacturing, you have to look at the sheer scale of the operation. At a certain size, tracking the cost of production stops being a matter of simple observation. In standard managerial accounting, some costs are perfectly transparent. Direct materials and direct labor are strictly observable. You can track the exact pounds of steel or hours of assembly time directly to a specific unit on the line, and those costs scale linearly with production. But as production scales, that transparency breaks down. Complex manufacturing environments generate massive expenses that defy direct observation or physical tracing to any individual product. These untraceable expenses fall into two main categories. First are joint production costs, where a single raw input yields multiple different outputs. Second is manufacturing overhead, which encompasses the shared ecosystem costs of running the factory itself, like utilities, maintenance, and facility taxes. Both of these categories sit beyond what we can call the traceability horizon. This is the exact point in the production cycle where solid, observable lines between a raw input and a finished product dissolve into a chaotic, untraceable cloud of shared expenses. Because these indirect costs cannot be physically traced to a specific unit, they have to be artificially assigned by accountants using mathematical allocation algorithms. The methodology used here is critical. Choosing the wrong allocation algorithm will severely distort the reported profitability of identical physical outputs, making a lucrative product look like a loss leader on paper. The ultimate purpose of cost allocation is not to reflect physical reality on the factory floor, but to engineer precise economic matching for the balance sheet. Consider a petroleum refinery that processes 1,000 barrels of crude oil, incurring $100,000 in joint processing costs. Eventually, that single input reaches a stage called the split-off point. This is the exact moment in the manufacturing process where the single batch of crude oil separates into 5 distinctly identifiable products: asphalt, fuel oil, diesel, kerosene, and gasoline. The problem is that all $100,000 was spent before these distinct products existed. How do we distribute that cost across the 5 final streams when none of it can be directly traced to any single one? The most basic approach is the physical unit method. This algorithm allocates joint production costs based purely on the relative volume or weight of the final outputs. This table outlines the output breakdown. Asphalt accounts for 300 of the 1,000 barrels produced, absorbing 30% of the joint cost for a $30,000 allocation. The math is sound, but it ignores the actual revenue-generating potential of the products. Under the physical method, massive, low-value byproducts absorb massive amounts of cost. This forces them to falsely show an operating loss on the books, while small, high-value products show artificially inflated profits. Physical volume is a highly unreliable metric for cost allocation because it treats heavy, low-value outputs as if they were financially valuable. To fix the distortion created by physical volume, accountants shift to market-based monetary allocation algorithms. The first of these is the sales value at split-off method. This approach distributes the $100,000 based strictly on the expected sales price of the products immediately upon separation at the split-off point. This chart outlines the new allocation based on market prices. Because asphalt is relatively cheap at $60 per barrel, its total expected sales value is only $18,000. Under this proportionate rating, the joint cost allocated to asphalt drops significantly to just $13,846. This works perfectly if every stream can be sold right out of the pipe. But often, a product cannot be sold immediately at the split-off point and requires further processing to find a buyer. These additional expenses are called separable costs. A separable cost is an expense incurred beyond the split-off point to make a specific product saleable, and it can be traced directly to that exact product. The estimated net realizable value, or NRV, method accounts for this. Notice the middle section of this table. Specific separable costs, like $1,000 for asphalt, are subtracted from final sales prices before allocating joint costs. This shifts the proportions, assigning asphalt just $14,493. The estimated net realizable value method aligns cost absorption with the product's true final market value, precisely accounting for the unique processing efforts required for each individual stream. There is a third, more advanced joint costing algorithm, the constant gross margin percentage NRV method. Instead of working forward from the accumulated costs, this method works backward from a target. It allocates costs so that the gross margin percentage is mathematically identical for every single product in the run. Step 1 calculates the overall gross margin for the entire production run. Deducting all joint and separable costs from the $145,000 total final sales value results in a $38,000 gross margin, yielding 26.21%. That 26.21% is now locked as the baseline target for every stream. Next, deduct that 26.21% margin from each product sales value to find its target cost of goods sold. Subtracting separable costs isolates the exact joint cost allocation needed. The $100,000 total is distributed to mathematically guarantee no product shows a disproportionate loss. This rigorous allocation applies to main products, but manufacturing often yields byproducts, unplanned outputs like sawdust in a lumberyard or minor chemicals in a petroleum refining process, which have a relatively minuscule market value compared to the main joint products. If these byproducts are financially immaterial, the administrative cost of running them through these complex allocation algorithms actually exceeds the benefit of doing so. As a result, immaterial byproducts bypass joint cost allocation entirely. They are simply capitalized in a separate inventory account or recognized directly as miscellaneous revenue at the time of their sale. Advanced market-based allocation is an act of financial reverse engineering. It is designed specifically to enforce a predictable, comparable level of profitability across complex, interconnected product lines. Joint product costs are not the only variables hidden behind the traceability horizon. The second major category is manufacturing overhead, covering the shared costs of operating the factory itself. While materials and labor are strictly variable, overhead contains variable components like utilities and indirect materials, as well as fixed components like real estate taxes and straight-line depreciation. This creates a temporal problem. A company cannot wait until December 31st to calculate its actual, finalized overhead costs before setting the price for goods it already sold in March. To solve this, accountants use normal costing. Normal costing is the practice of estimating total annual overhead in advance and creating a predetermined application rate to apply those costs to inventory evenly throughout the year. This summary details how predetermined rates are tied to an allocation base. Variable overhead is tied to units produced, generating a rate of $4 per unit. Fixed overhead is tied to machine hours, resulting in a rate of $2.50 per machine hour. This exposes a structural paradox in the accounting. Fixed costs are static by nature, but we are forcing them to be applied using a fluctuating, variable metric, actual machine hours, just to attach them to the inventory as it moves through the factory. Applying a fixed cost via a variable allocation base is a necessary accounting fiction, but it guarantees the applied cost estimate will eventually clash with actual cash outflows at year-end. The inevitable fallout of normal costing is over-applied or under-applied overhead. This is the variance between the estimated overhead applied to inventory during the year and the actual bills paid by the factory. If the variance is minor and considered immaterial, it is simply closed directly into cost of goods sold to clear the books. But if the variance is material, dumping it all into cost of goods sold would violently distort the income statement. The solution is proration. A material variance must be retroactively allocated based on the relative values of work-in-process inventory, finished goods inventory, and cost of goods sold. This example details a scenario where fixed overhead was over-applied by a massive $85,000. To fix this, manufacturing balances are assessed to determine the proportional weight of where costs reside. Here, 20% is in work-in-process, 10% in finished goods, and 70%. Whether mitigating the physical distortions of joint products or reconciling the volume variances of fixed overhead, mastering cost allocation algorithms is what separates standard bookkeeping from strategic financial management.